Welcome back to the deep dive. We've got a really interesting set of documents today, focusing on India's affordable housing finance sector. Specifically, we're looking at India's Shelter Finance Corporation Limited, or ISFCL. Yeah, their Q2 results for fiscal year 26 just came out, and we want to really dig into them.
That's right.
So our mission today is basically to sift through the earnings call, the investor presentation, and figure out, well, two main things.
Okay.
First, how did ISFCL keep up this, frankly, a pretty aggressive growth they've been showing? And second, what are they actually doing about asset quality? Because you hear whispers, industry concerns bubbling up.
Right. That's the key tension, growth versus risk in this space.
Exactly. So let's try and unpack that. Maybe start with just reminding us who ISFCL actually serves.
Sure. So fundamentally, ISFCL provides affordable home loans and also loans against property, LAP. Their focus is squarely on the low and middle income groups.
Yep.
And geographically, we're talking primarily Tier 2 and Tier 3 cities in India. Think of smaller cities, towns. They're banking on, that aspirational middle segment of the country.
Got it. And looking at the earnings call, management seemed pretty upbeat about the bigger picture, the macro environment. What was their take?
Yeah, they were definitely bullish. They highlighted the expectation that inflation might be coming down, which obviously helps their borrowers directly, more disposable income.
Makes sense.
And critically, they talked about a positive outlook for agriculture. Good monsoon expected, which they believe translates directly into stronger rural demand.
And are they seeing signs of that already in actual sales?
Well, they cited things like solid numbers for FMCG goods, tractors, motorcycles. Those rural indicators look pretty robust to them.
Okay.
And then on the government side, they mentioned continued capital spending. Plus, they flagged something they called GST 2.0 reforms as potentially boosting consumption and credit expansion.
GST 2.0 reforms. Okay, for listeners maybe not following Indian policy super closely, what's the implication there? How does that help credit?
Well, the idea, I think, is further streamlining of the goods and services tax. Better efficiency, more formalization. It helps small businesses, right?
Yeah, many of their customers are self-employed.
Exactly. So if those businesses become more formalized, their financials look better, their credit profiles improve, that underpins broader credit growth. It's a bit of a virtuous cycle they're hoping for.
Okay, that provides good context. Let's see if the company's own numbers back up that optimism. What about the core growth metrics, AUM?
Yeah, the headline number definitely supports the growth story. Assets under management, AUM, hit Rs, 9,252 crores.
Wow.
That's up 31% year on year, which, in this specific affordable housing segment, sustaining over 30% AUM growth. It's tough without taking on significant risk.
And how much new lending did they actually do in the quarter? Disbursements.
So for Q2 itself, disbursements were Rs, 931 crores. That's about 12% growth year on year for the quarter.
Okay, a bit more measured for the quarter.
A little more measured, yeah. But if you look at the first half of the fiscal year, H1, disbursements grew a stronger 18% year on year, totaling Rs 1,817 crores. So the pipeline is still quite active.
And they're physically expanding too, aren't they? Adding branches.
That's a core part of the strategy, planting deeper roots in those non-metro markets. They added 9 new branches just in Q2.
9 in one quarter.
Yeah, brings their total network to 299 branches across 15 states.
Yeah.
So literally putting more people on the ground in those Tier 2, Tier 3 locations to keep the engine running.
Okay, so growth looks strong, expansion is happening, but like you said, growth needs quality. Let's shift to profitability and efficiency. How did the financials look for Q2?
Very strong, actually. Profit after tax, PPT, came in at Rs 122 crores for the quarter. That's a 35% jump compared to last year.
35% PT growth is solid.
It is. And the first half, H1, looks even better on a growth basis. PP grew 39% year on year to Rs 241 crores.
Now, the number that always jumps out with these guys is return on equity, ROE. Where did that land?
Still very robust. The annualized ROE for Q2 was 17.0%.
17%. That's really exceptional for a lender in this, inherently riskier, affordable segment, isn't it?
It absolutely is. It shows they're using shareholder money very effectively.
Yeah.
And you see that efficiency show up in their cost management, too.
How so?
Well, their operating expenses relative to AUM, that ratio actually declined. It came down to 4.1% in Q2, from 4.4% the previous year.
So down 30 basis points. Hold on, let's pause there. A basis point is 0.01%, so a 0.3% improvement. What's driving that efficiency gain? That seems quite significant at their scale.
It really speaks to the operating leverage they're getting from that branch network. As the AUM grows, the cost to manage those, 299 branches doesn't grow quite as fast.
Okay, scale benefits kicking in.
Yeah, optimizing roles, using technology for loan origination, it all helps. And that resulted in a cost-to-income ratio of 35.5%. Pretty comfortable.
Right. Now, the core of lending profitability is the spread, right? The difference between what they earn on loans and what they pay for funds. Portfolio yield was stable at 14.9%, you said?
Stable at 14.9%. Yes.
So what happened on the other side? The cost of funds? Cough.
That's where they made gains. They managed to bring their cost of funds down by 10 basis points just in the quarter on quarter, down to 8.5%.
10 basis points down in Q2. Okay.
And here's maybe the key forward-looking bit. Management is guiding for another 20 basis point reduction by the end of the fiscal year.
Another 20. So potentially down to around 8.3%.
That's the target, yeah, around 8.3%.
So a potential 30 basis point drop over the year, that's quite powerful for margins.
Definitely. And that combination, stable yields, falling costs, allowed them to actually increase their spread. It was up 30 basis points year on year, maintained at 6.4%.
How are they pulling that off, getting cheaper funding when, liquidity hasn't always been easy for everyone?
It seems to be smart diversification of their funding sources. I mean, first, they have a huge liquidity buffer over ours, 2,000 crores.
Okay.
But they're also tapping into cheaper sort of top-tier institutional money. They got new sanctions recently. Ours, 550 crores from the National Housing Bank, NHB, which is a key source for HFCs.
Right, long-term funding.
Exactly. And interestingly, for the first time, they secured a sanction of ours 500 crores from CDBI.
CDBI, the Small Industries Development Bank. That's new for them.
First time getting a line from CDBI, yes, which is, a pretty big stamp of approval.
Yeah, definitely a vote of confidence.
Absolutely. It helps diversify their borrowing base. They mentioned having over 30 lenders now. And crucially, it helps lower that overall blended cost of funds. That feeds right into that improved 6.4% spread.
Okay, so the financial picture looks, well, pretty rosy. Strong growth, good profits, improving efficiency, smarter funding. But there's always a but in lending, isn't there? Especially affordable lending. Profit means nothing if the loans go bad. So let's talk asset quality. This seems to be where the real story, the real tension lies based on the documents.
It is. And if you just look at the standard sort of lagging indicators, they look fine.
Yeah.
Gross stage 3, think gross NPAs and net stage 3 net NPAs, they were stable, held steady at 1.2% and 0.9% respectively.
Okay, 1.2% gross, 0.9% net, stable.
Yeah, so on the surface, realized losses aren't spiking. They're holding the line there.
You hinted that those headline numbers might be masking something. What did the investor sources really flag?
They did. The sources, and management acknowledged this, pointed to a definite spike in early-stage delinquency, specifically loans that are 30-plus days past due, DPD.
Ah, the leading indicator.
Exactly. This is the canary in the coal mine for potential future losses.
And what was that 30-plus DPD number?
It hit 4.7% as of September 30th.
4.7%. Okay, that does sound like a significant jump, especially compared to maybe industry benchmarks or their own past figures. That's the number that would definitely raise eyebrows for investors, right?
Absolutely. Management was, quick to address it on the call.
Yeah.
They attributed partly to just general stress, maybe filtering through the system, but they heavily emphasized seasonality.
Seasonality, like what?
Like the monsoon season potentially disrupting income for some borrowers, and also the timing of GST payments, which can create temporary cash flow squeezes for their self-employed customer base.
Okay, seasonality could play a role. But you also hear general chatter about stress, specifically in that, say, Rs 5 lakh to Rs 10 lakh loan ticket size across the industry. Are we just taking their word on seasonality? Especially since they're sticking to that aggressive 30-35% AUM growth target despite this 4.7% DPD number.
That's the critical question. And that's where you have to look really closely at ISFCL's specific model and the buffers they claim to have. They lean heavily on two things that they argue differentiate them, especially from perhaps non-bank lenders seeing stress.
Okay, what's the first line of defense?
Their status as a registered housing finance company, an HFC.
Right.
This isn't just a label. It grants them specific, quite powerful recovery tools. Most importantly, the ability to use the Sarfazi Act.
Okay, explain that for the listener. What does having Sarfazi rights actually let them do? Why is it such a big deal compared to, say, a regular NBFC?
It's a game changer for recovery. Sarfazi basically allows them, as a secured lender against property, to enforce their security interest. That is, take steps towards seizing or auctioning the underlying property without having to go through a potentially long, drawn-out court process first.
Ah, bypasses the courts, speeds things up.
Massively. After giving the required notices, if the borrower doesn't pay up, they can move much more quickly to secure the asset. It creates enormous leverage to push for a settlement or resolution, minimizing the time that loan stays non-performing.
Okay, so a significant legal advantage. What's the second buffer they point to?
Their conservative loan-to-value ratios, LTVs. They maintain their overall portfolio LTV at just 52%.
Only lending about half the property's value.
Exactly. And even for the loans against property book, which can sometimes be seen as riskier, they typically keep LTVs under 50%. So there's a huge equity cushion built in from day one. Even if they do have to recover the property, the asset value provides a very substantial buffer against actual loss. That protects the bottom line, protects that 17% ROE we talked about.
And given this DPD spike, are they pulling back on certain loans? Are they avoiding those Rs 5 to 10 lakh loans people are worried about?
Nope. That's what's really interesting. They explicitly said they are not pulling back. They're continuing to lend actively in that very segment.
Wow, okay. That shows real confidence or maybe reliance on their underwriting and those recovery tools.
It absolutely suggests confidence in their proprietary underwriting for that self-employed segment. Their target loan mix is unchanged too. Still aiming for roughly 60% home loans, 40% LAP.
Let's make the recovery process more concrete. When they do invoke SARFAESI because a loan has gone bad, what actually happens? Does it always end up with them auctioning the house?
Well, the sources gave a fascinating insight here. They said historically about 85% of their MPA cases actually get settled after they initiate the SARFAESI process, but before an auction.
85% settle.
Just from the threat, basically. It seems the credible threat and the speed of the process are often enough to push the borrower, or maybe their family, their network, to find a way to resolve the debt. They want to avoid losing the property.
That's a huge number, so only 15% or so actually go all the way.
Roughly, yeah. Only about 12% to 15% of cases historically proceed to a full property auction. That high settlement rate is absolutely key to how they manage to keep their overall credit costs low. They guide for 40 to 50 basis points, remember. It prevents delinquencies turning into large write-offs. And if we swing back to the customer for a second, it really highlights how their whole business model is built around understanding and underwriting that self-employed group.
Right, the 75% of their book who are self-employed, that's their growth engine, but like we said, it's also where the risk assessment gets tricky. Documenting income is harder.
Exactly. It requires, as they put it, having honed the skill for underwriting this segment. They rely heavily on their internal data, their feet on the street knowledge.
Which makes that 4.7% DPD number such a crucial test, doesn't it? It really puts that honed skill to the test.
It absolutely does. It tests whether their proprietary models are truly capturing the underlying risk in the informal economy.
And there were some other interesting customer profile points, too, like 71% are first-time home buyers.
Yeah, 71% first-time mortgage borrowers. So they're genuinely bringing new people into formal housing finance. And that stat, about 99% of loans having a woman applicant or co-applicant.
99%. Why is that so high?
It often reflects targeting the household unit, potentially leveraging, women's perceived financial stability or community standing in some cases. It's a common strategy in affordable finance. Their average loan size stays steady too, around that Rs 10 lakh mark. Perfect fit for the segment.
And focusing on Tier 23 cities probably helps insulate them a bit too.
Somewhat, yeah. Less exposed perhaps to volatility in, say, large export-oriented businesses that might be feeling global headwinds more acutely. Their customers are more tied to the domestic, local economy.
Okay, let's touch on internal stuff quickly. Managing these risks requires good people. Are they doing anything specific to keep their team, especially those on the front line?
Yeah, retention seems a big focus. They mentioned their overall attrition rate is stable, which is positive, but they specifically highlighted expanding their employee stock option plan, their ESOP scheme.
Okay. Expanding it how?
They're adding 500 new employees to the ESOP pool. And significantly, this includes branch managers and key frontline staff, the people actually doing the underwriting and collections work.
500 more people getting stock options? That's quite a few.
They said it covers over half of the relevant employee base in those roles. It's a clear move to align the incentives of those crucial ground-level staff with the long-term health, particularly the asset quality of the company. Keep everyone focused.
Makes sense. Give them skin in the game. And just a minor point, they also tied it up by liquidating an old subsidiary.
Yeah, India Shelter Capital Finance Limited. It was non-operational, Basically a legacy entity.
Hmm.
Just a bit of corporate housekeeping, they said. Non-material financially, just simplifies things and keeps the focus purely on the main HFC business.
Okay. And through all this, they're reaffirming guidance, still aiming for that 30-35% AUM growth and stable credit costs.
Yes. They seem confident that the Q2 DPD spike was largely seasonal or manageable, and that the second half of the year, H2, which is traditionally stronger, will see things normalize. They're sticking to their guns on growth and credit cost guidance.
All right, let's try and wrap this deep dive up then. Pulling it all together, ISFCL is clearly showing some impressive numbers. You've got 35% PPT growth, that really strong 17% ROE, operational growth still running hot at 31% AUM, backed by that expanding branch network, and seemingly smart funding diversification.
Definitely. But the whole narrative really pivots on risk management, doesn't it?
Yeah.
The headline NPA numbers look okay, stable for now.
Right.
But they do mask that quite significant jump in the early warning sign that 30-plus DPD hitting 4.7%.
So the whole success story, really that ability to generate a 17% ROE in the tough, affordable housing market, it all seems to hang on whether their special sauce actually works. Their underwriting for the self-employed, and maybe more importantly, their recovery process.
Absolutely. Their confidence lets them keep playing in a space, that Rs 5-10 lakh segment, where others might be getting nervous. It relies on their unique HFC status and those Sarfisi powers.
Okay, so here's the final thought, the provocative question maybe, for you listening. Given how much ISFCL seems to rely on those Sarfisi rights and their claimed ability to settle most cases quickly, that 85% historical settlement rate,
Yeah.
the real test for their high profitability, for that 17% ROE continuing, is whether that settlement rate holds up under this current stress. If that 4.7% early delinquency starts translating into fewer quick settlements, if more cases do have to go the distance.
Then their credit costs could rise quite quickly.
Exactly. Their ability to keep credit costs stable, keep that ROE elevated, could change fundamentally, almost overnight. So that settlement efficiency driven by Sarfisi, that's probably the single most important metric to watch in the coming quarters.